Well, hello, everybody. Thanks for joining us for the proven pricing strategies for vacation rentals. And I have three people with me today. And my name is Sarah Franzen. I am with Natural Retreats. I'm the Director of Revenue Management and Analytics there. And I am really excited to have these three gentlemen with me today. I'm going to let them introduce themselves. Anurag, I'll pass it to you.
Thank you so much, Sarah. Am I starting the presentation right away?
If you want to just introduce yourself,
All right.
quick.
I'll just do a quick introduction in that case. Hi, everyone. This is Anurag Verma. I'm one of the co-founders at Price Labs. Price Labs is a revenue management software for the vacation rental industry and started about 5 years back. Yeah, that's more or less it. I'll hand over to Josh.
Hi, everybody. I'm Josh Marquis. I'm the president and CEO of Great Western Lodging in Breckenridge, Colorado, and Retreatia in Steamboat Springs, Colorado. Right now, although I'm running the companies, I was a revenue manager for a couple of years for a company called Vacation Palm Springs, which was a Wyndham, now Vacasa business unit. So yeah, software developer turned revenue manager turned, I guess, executive now. So thank you.
Yep. Hey guys, I'm Max Schuster. I'm the Chief Revenue Officer here at Stay Marquis. We're a full suite revenue vacation rental management company. And so we'll get into some of our strategies that we're employing here in a bit, but let Anurag talk a little bit more broadly about the process.
The floor is yours, Anurag.
All right. Thank you so much, everyone. All right, we've already done the introduction, but this session is about proven vacation rental pricing strategies. And the agenda is actually very simple. We're keeping it straightforward. We are focusing on pricing because this conference is all about it. And we're going to start with some very basics, like why should different guests pay different amounts for a night at the same home? Like, why is each night a different product? Most of you know the answer, but I want to ask that question and throw some adjacent questions around, which should help us answer future questions. And then the second one is common pricing levers. So this is about proven strategies. So most strategies that are proven end up becoming common use. So we are going to look at some common levers, and even though we have been using those, even though you have been using those, I still want to bring out some elements of it that might be new and some that might not be new. We'll just have a discussion here. So this is going to be sort of a broad, higher level discussion. Starting off with what is the product? So in some ways, when you think about pricing or revenue strategy, you have to think about like what is the product you're trying to sell. And for us and for you, each home has 365 nights, which in some ways are a product by itself. So each night and each home are a product. So for every home, you have 365 products to sell. That doesn't mean that every year you have 365 transactions. And the first bullet point is harping on that for us in our industry, bundling, if you think about this as an online retailer, bundling is when you buy multiple products together. In our industry, it's very common to bundle. You don't want to sell 365 nights individually to separate people because it's going to be an operational nightmare. It's going to be a nightmare with cleaning. It's going to be a nightmare in so many ways, right? So, but it is a conscious choice that we are making, that we want to sell as a bundle. So I want to think of when you sell multiple nights of it as like we are selling a bundle in some ways. The second one is pricing. You can sell each of these products at the same price, or you can sell those products or those nights that are in more demand at a slightly higher price or a much larger height, depending on how much more or how much less demand they're in. Now, with anytime you're selling anything, you have to know that you're also going to not sell things to people. So suppose you're in a low demand period and somebody comes and says, hey, I want to buy your product. And in most cases, in most economic theory, the right price is to figure out, one, what makes you a profit. If it's not profitable to sell, then you don't sell. And two, if you can figure out how much somebody is willing to pay, then you should like charge that. Like if somebody is willing to pay $1,000 a night, why charge $800, right? So when you're in low season and you know that, okay, the demand is low, we are not expecting to be very full, you can still refuse offers. You can still come and say, hey, somebody is willing to take my place at $80 a night, but I know that it's not going to be profitable to me, and I'm going to refuse that offer. So, and you might not do that consciously. Somebody might not come to you and say, I'm willing to pay $80. Maybe they come to your website and sees all your prices are $100 and just go somewhere else. That is refusing an offer. You don't get to know about it, or maybe you do if you have some analytics set up there, but you get to know that, but you are refusing an offer from somebody who would have potentially bought at a lower price. The second kind of refusing the offer that you do is when there is high demand. And the same concept applies in a different way. Now, somebody might be willing to pay $800 for your per night for your property, but you know that the demand is so high that you can sell this for $1,000 a night. Like in that case, you're going to set your price at $1,000 and you're going to reject anybody who's willing to pay less than that, because you know that there are people who will be willing to pay more. The next sort of thing that makes it interesting from a revenue management perspective is each night is a perishable product, and the word perishable historically gets used in grocery stores, right? They sell things which are have a longer shelf life versus fruits and vegetables that perish soon. Each night for us is perishable unless you sell it by the time the night happens. Like you can't sell a night in the past at your home. The next is, in any revenue management, you always have to think about how much do you want to sell and at what price. So this is about, do you want to sell a lot by making it cheap, or do you want to sell a little by making it expensive? And the right answer is always somewhere in between. You want to sell enough of it at the right price so that you maximize your revenue in some ways. And for vacation rentals, the uniqueness question is something that's unique in the industry, in the travel industry, because unlike planes where you're selling 100 of the same seat, or hotels where you have 100 of the same room type, here each home is unique. So you can only sell each home once, and that home is unique. So you can't always say, because this other home got sold for this much, we should sell this home for the same price, because there could be differences. And I want to harp on that uniqueness question a little bit more, because the answer about whether the price should be same for two properties or not isn't just dependent on whether you think that the homes are identical. They might be right next to each other. They might have the exact same amenities, the exact same design. What matters more is, what do the prospective guests, the people who are booking, think of it? So the value to them is the perceived value. They don't know everything about your property. All they know is what they get to see at whatever place they book at. So whether it be an OTA, whether it be your own direct booking channel, the pictures, the reviews, where they show up in the rank, all of this matters. So they might be identical homes, but you might need to set different prices. It's the identical product, but because it's being sold through online channels, the perception also matters. So the uniqueness question really comes into play when trying to figure out how to price properties relative to each other. There are what I really want to get into today from a pricing perspective is, one, that part of like, how do you price properties relative to each other, but more importantly, like, because you have 365 nights, what kind of things have people sort of figured out? Like, what have people been doing for a few years now, and those that seem to be working fairly well. And so I've tried to break this down into 5 categories, and these are 5 broad categories. And they are subdivided into 2 categories. The first one on the top is things that are widely used, they are well understood, and they are easy to implement. And those 2 are your seasons. Most people, most managers who are into pricing and into revenue management understand what their seasons are. They also understand what their day of week patterns look like. And in many ways, as we'll talk, these pricing strategies in response to those 2 factors are somewhat easy to implement. A lot of people have been setting seasonal prices for the longest time. A lot of people have been setting weekend pricing for the longest time. The next 3 are booking window, length of stay, and holidays and events. And they are also widely used. Almost any revenue manager in the industry, almost any business in the industry knows about these. There are some intricacies that are a little more complicated. So I'm going to show some examples of like there's some conventional wisdom, but everybody has different conventional wisdom for a reason because they have a different experience with these strategies. And they are also slightly tougher to implement. So if you think about seasonal and day of week pricing, the reason it's so common and so popular is it can be done in the beginning of the year, and then you sort of, if you don't think of anything else, that's it. That's all you need, right? Now you don't look at it again. But we say like generally doing the next three is also super important. It does take some effort. So you will need either somebody who's focused on it, or systems that are focused on it, or just you putting in more effort. But yeah, with that background of like how we have tried to categorize this, I'm going to jump into the season part. Sarah and Josh, if you have questions on anything as they come up, feel free to stop me. But if not, I'll just continue. So talking about seasons, so most people in this industry know about their seasons. Also because in most cases we are in destinations where seasonality is very prominent. Like if you think about cities, cities tend to have much more muted seasons because there's also a lot of business demand. There are also things that you can do in cities that don't really depend on how the weather is. Whereas in a lot of destination locations, there is specific reason people come to a destination. If you're in a ski location, for example, or if you're on a beach location, then generally July and August are going to be super big in the US. Most people know their seasons. One of the things that we have seen folks not do as well, and where there is significant benefit to trying and doing, is what do you do on the shoulder season? A lot of times when we see people using seasonal pricing, it's almost a cliff. So all the way till June end, the price is $300, and then July starts and the price goes to $600. And that's done partly because it's easy to define fewer seasons over the year, because depending on which system you're using, entering seasons can be a hassle, right? What we have definitely seen is the shoulder season is real. So as much as possible, you should try and make it a little more granular. Instead of having one big jump, have three smaller jumps, depending on, and you'll see this if you've historically had cliffs, that if in this example that I gave, that where till June end the price is 300 and starting July it becomes 600, that you will see that, hey, June end is getting a lot of bookings, and actually this is a bad example because July 4th will still get a lot of bookings, but June end is getting a ton of bookings. Maybe you can raise the price a little bit higher and then go week by week there and slowly gradually bring it down to 300 in that case. So the key insight I would say when doing seasonal pricing is to think about shoulder season, because unlike low season where demand is low, shoulder season, it has the reason it's shoulder, it's because it has some demand that can be tapped. So if you're not pricing that shoulder season properly, you might miss out on significant revenue. The second one is day of week trends, and again, these are fairly well understood. But what I would really request everybody to look at is, one, look at how you're priced for day of weeks, and two, what kind of check-in patterns you get. So in this example, the middle chart, I have the check-in patterns where in this location, it looks like a ton of people are checking in on a Friday, probably for a shorter weekend stay. And then look at your lead times as well. So we'll come into lead time very soon when we talk about booking window, but lead time generally, when people book farther out, it generally means there is more demand compared to others. So generally, if you are a weekend heavy destination, you'll see that demand for weekends will be booking farther out and things like that. So look at what your rates have been historically and what your revenue by day of week or occupancy by day of week has been. So if your rates have been like this and your occupancy is flat, that's essentially saying you're using your rates to sort of normalize your occupancy over the day of weeks almost too much. Like if the demand is higher, it's okay to have a little bit higher occupancy. Like you might be increasing your weekend prices too much, or maybe you're reducing your weekday prices too much in some ways. So think about those things. Think about experimenting a little bit. If you're using some of this to say, okay, if I bump up my midweek prices by 10% and my occupancy for midweek only drops by 5%, you're making more money in this case. So even though the occupancy might be slightly lower, it might be worth doing.
And one thing that I'll just throw in really quick,
Yeah.
as I'm listening to this, all of it is great and very applicable. I know that there are, we kind of have a variety of people, diversity of, I guess, experience in the audience. And so one of the things that I would say is that, all of these things are really valuable, but, if you can only start, if you have those cliffs, like you were talking about with the seasons, or kind of how you're pricing your day of week, don't be afraid to just kind of ease into this a little bit. So if you know that you had that traditional cliff here and, well, I've got to be monitoring everything and knowing how everything's, you can start with kind of your structure and then start monitoring demand and make those adjustments as we go in response to market. I think sometimes it's a little overwhelming when you start thinking about, oh gosh, well now I've got to like start tiering and
Yeah.
making my rates gradient or whatever, and it can be something that you can do pretty easily.
Yeah, I mean, absolutely. So in the seasonal cliff pricing example, I said 3 tiers, start with one, like make the
Yeah.
last week of June $450 and see what might happen. And
Yeah.
you might be surprised, right? Yeah.
Yeah, and your shoulders may shift because you may have a pandemic or something, and
Right.
the traditional seasons aren't exactly the way they've been. So
Yeah.
I just wanted to keep going.
Absolutely.
Sorry about
No, this is it's better when more people speak.
that.
No, but Sarah, to your point there, we are going to come to the next topic, which will sort of answer the deeper question of like there might be shifts in seasons and things like that, and how to deal with those, right? So the next major theme I want to look at, let me look at the time as well, is booking window. If you have your own booking history, which you should, I mean, you should have access to this, and anybody data savvy in your team, they should be able to create a chart where it shows you what kind of, so on x-axis here, for example, you see lead times. So how many people books like super last minute within the last 2 days, within the last week, in week 2, in 15 to 30 days, and so on. And you can make your own buckets depending on what works for your market, right? But really try to see, like, this is data that I've pulled from Sedona, where it seems like very few people book last minute, and I'll see some examples where something else very different happens. Like it is a market, especially right now in Sedona, a lot of people might be booking for the winter or spring already, which is what's showing here. Now, if you're in such a market where you see that, okay, I get very few last minute bookings, there might be some merit to you saying that, okay, if it's within 15 days and I have there are nights in my portfolio that are not sold, and these are longer chunk of nights, right? Like if it's a 1 night or 2 night gap, you might not want to sell it, or maybe you want to sell it, but you have to then figure out what the price should be. But suppose you have a longer chunk, a week left on a property, and it's not sold. Looking at this data might tell you that, hey, if it's not sold till 14 days out, the chances of it getting sold are probably slim, because very few people historically have booked last minute in my location. I've put a star on this one because there are cases where even if the curve looks like this, you might want to say, hey, I know I'm not sold, but I know that everybody else is sold. So whatever few people are coming in, they have to book my property. I don't need to discount this one. So think about a scenario like this and look at your own data. You should be able to look at your own data, put it in Excel, or there are tools available right now that various data tools that will do this for you, and see your own data and see like what kind of strategy should you start applying. Now, just to give a counter example, I took another example, which is Pigeon Forge, and some of this might have to do with seasonality as well. Like in this market, in the last, and this is looking at bookings that were made in the last 30 days, for example, it's saying, unlike the previous one, there is a ton of bookings seem to be coming last minute. Like, how do you then respond to this? Like, the answer was very easy to think about in this one. What do you do in a market like this one where a ton of bookings are happening last minute? And the answer is not either like discount them or put a premium because a lot of people are booking last minute. The answer depends on how much of inventory is still left on the market. So if a ton of people are booking last minute, but if the number of nights, if the number of places that go unoccupied is also significant, is more than 30-40%, then you'll say, hey, sure, a lot of demand comes last minute, but they have so many choices to go with that, and my inventory is about to expire, that I need to do something about this.
And
Josh,
that
you got a
is
comment?
probably where demand would come in, right? I mean, this is just a pricing session, but that would be a perfect opportunity to check and see what's currently in demand in your market.
Yeah. Josh, I think you had a comment.
Oh, no, I didn't. I was just unmuting myself in case I did.
Got it. All right. Perfect. Cool. All right. Now, I'm going to spend a little more time on the booking window question because Sarah brought up the pandemic and she didn't know about this chart. But one of the things we looked at, and I can't remember which market this was, but we were trying to figure out, like, how did things change for July of this year compared to previous year? And so what we did was we tried to benchmark to say, okay, we are going to say, as of January, normalize all the demand that came till January, because January was still pre-pandemic, and then see how things changed after that in the normalized world. And 2018 is this gray bar, 2019 is this blue one, not bar but line, and you can see that already there is, over time we have been seeing in this industry a shift towards more last minute bookings and shorter booking windows. But the red line is this year, where like in March and April, just nobody was booking. So July was basically whatever bookings would have come here, it was all empty. But it made up for it in the end. So at this point in April, you might have looked at your, like, if you were looking at your booking curve, you would know that, okay, July is just going to be empty, except things bounce back. So one of the things to look for in this booking window is always to be monitoring, like, where you are compared to historically where you used to be, to tell you, like, should you do something about your pricing? And fair enough, at this point in April, nobody knew that it's going to bounce back so much. So maybe the answer was to reduce your prices, because, hey, let's sell whatever we can in some ways while still being profitable. And as it starts going up, if you're monitoring, you would know that, hey, sure, I lowered my prices and got a few bookings, but seems like a lot more is happening now. I should raise prices and get those bookings, the bigger chunk of bookings, at a better rate in some ways. And then the last thing on this topic that I want to bring out is this idea of pacing. In a lot of industries, especially with like airlines or hotels, or resorts even, we do pacing where we say, okay, we generally want this much of inventory booked by this booking window and things like that. And if you look at this chart, if you have the table, if you have 5 properties, what I've done is for the next 10 days, and you probably look at this for the next 180 days or something like that, you can say, okay, for each day, I want to know what's booked, what's not booked. And you can look at it in 2 ways and try to think about pace in a different way for each. One is that for tonight, I'm only 20% booked. I need to probably do something, although it might be too late. If somebody is looking to book, I need to attract them with some discount or something. Whereas on this day 5, I still have like a few days to book, and I only have 1 vacant property. I don't have to sort of panic in some ways. I can say, okay, let's try and get a booking, but if not, that's okay. I'm doing fairly well for this day. That would be true in a resort situation, where what matters to you is how all 5 do overall versus how each property does. What happens in vacation rentals is you have separate owners to answer to. So instead of looking at it from a vertical every day, how is my entire portfolio doing, you also have to think about every property, how is it doing? Like over the next 10 days, I have this property that's only 10% booked. I probably need to take some action on this property. They might be, again, identical properties, but hey, this one that hasn't really booked, I need to do something about it. So that's the other sort of paradigm to think about when you think about pacing, that it's not just about how your portfolio overall is doing, but also how each property is doing. The next topic I want to quickly address is length of stay, and this is super important right now in some ways, because in many markets we are seeing the length of stay increase and more people looking for extended stays. And I want to quickly throw this hypothetical question where, suppose you're selling each night for $100 on average. So we have all been discussing how each night should be different, but then in this example, to make it simple, let's say it's $100 a night, and you're in a market and your portfolio is seeing 80% occupancy. So on average, from a property, you should make 100 times 30 times 80%. So $2,400. You expect 24 nights to be booked. And if you give a 20% extended stay discount for monthly stays, then you come to a place where you make the same, like you're selling for a 20% cheaper rate, but selling all the nights because you got a month-long booking and you're making the same amount. So giving a discount of anything more than 20% is probably not a good idea from a revenue perspective. It might still be a good idea from operational perspectives because it's lesser hassle to manage longer stays. Whereas if you're in a market that's not doing very well right now or is entering the low season, you might need to think about, hey, at my nightly, or if I only book short stays and I'm filling it up with 50% occupancy, I make $1,500. Whereas I can probably give a 40% or 30% discount and make much more than that. So it might seem like a crazy amount of discount to give 30% discounts, but think about it as if you don't give it and you only get short stays, what happens? Versus if you give it and try to attract these longer stays, what happens? Now, just because you can doesn't mean you give that discount. If you're giving a 20% discount and you're getting longer stays, fair enough. The market is willing to pay that value, don't do it. But if that's not happening, then this helps you figure out what's your limit. Like this is very back of the napkin kind of a calculation, but it helps you figure out what that limit should be. There are, of course, caveats to this. Like if you might be entering low season and do this, just make sure that you don't have a 50% monthly discount set up for like your next year's high season where it might be full and you sell out for a 50% discount. So be very careful when doing these kinds of discounting that it only applies to certain periods of times and things like that. But extending that a little bit, and I know Max is going to talk about this a little bit, in many systems, most systems allow for weekly and monthly discounts, but many systems also allow for discounts for shorter, premiums for shorter length of stays and discounts for the entire spectrum. Like you don't have to sell every night at the same price regardless of the length of stay. If your system allows for it, it gives you so much more flexibility. You can say, hey, on average, I want 4 nights or longer. I'll take a 2-night stay if they're willing to pay an 80% premium. Like I almost get the same amount and I have fewer nights booked. Why not in some ways, right? So if your system allows for this, also think about doing something close to like having a gradient of short stays. And you can say, hey, I never want 1-night stays, so no premium, no discount. Maybe put 1,000% discount premium or something like that, or just not allow it with minimum stays. And the last one, this is going to be quick, and I'm also probably out of time, is holidays and events. If you look at your forward-looking curve for your portfolio, or if you're getting market data from somewhere, you will be able to notice that there are certain weeks, certain weekends, certain midweeks where sometimes you know what's happening, sometimes you don't know what's happening, but a ton of activity seems to be happening in your market or in your portfolio. It's important to always be looking out for that. So if a lot of people have well-known holidays as high season, as a short season, for example, Thanksgiving or New Year's, but also look out for your booking curves, for forward-looking curves, to see are there dates that I don't think of as big events where this is happening, because maybe there's some lesser-known thing happening that I can raise my prices for, and go ahead and do that. Also realize that some of these events, depending on the event, some might book early, some might book last minute, like depending on who the audience that event or holiday is catering to, it might have a very different booking curve. With that, I know I sort of ran through this very quickly, but if you have more questions, feel free to send them through here and we'll try to answer those, or send them directly to us.
Yeah, I was just going to say that you can use the chat box up there. If you have any questions, send them in and we are monitoring them. So with that, I'll turn it over to you, Max.
Okay, great. Let me just make sure sharing the right screen here. Can you guys see the right one? Okay, great. So, here just want to go through again, sort of a couple key goals where we want to make sure that we're going through an overview of our experience as Stay Marquis in these luxury markets that we're playing in, the approaches that we're taking to pricing, and then how to choose a pricing strategy, sort of what those choices are from a framework perspective, and how to actually arrive at numbers to fill in that framework. So obviously it's great to have an ironclad framework, but if you can't put the numbers together using data, it becomes a bit of a challenge. And so just going into sort of our experience as Stay Marquis, we were founded in 2016. Over that time, we've grown to about 1,000 properties, which has been really great, and we're adding properties on a rolling basis. So even still today, we're adding properties for 2020. We're largely based in the Hamptons with a growing presence in other luxury markets like Aspen, a little bit in Hudson Valley and upstate New York as well. And then one of the things that I want to hit on here is all of our technology and our capabilities are custom built in-house, and that's to allow us to be extremely flexible and have a really high degree of customization. And that's something that I'll get to in the next couple. I'm sorry? That's something that we'll get to in the next couple of slides, but that's really what's facilitated our performance here. If you take a look at our track record, and we've been able to almost double year over year for the past 3 years, and really expect that trend to continue going forward. And so that's really predicated on our ability to have that custom data analytics platform, a dynamic pricing tool that's patent pending, having property management software, lead management, reservation, really that full suite is what has been facilitating our success here. And so, as I mentioned, we're really in these luxury markets. Because of that, they're extremely competitive as they do have really high revenue potential. And so to successfully compete in those types of environments, what you've got to really understand is, one, what are the market characteristics? So how are they defined and what are the rules around them? And then two, who are the key players in the market or the key stakeholders? And how do you, as a property manager, interact with those stakeholders? And so just high level to understand sort of our markets, it's really difficult to obtain exclusivity. There are multiple listing servers, online and offline. We do require online exclusivity, but that doesn't mean that there aren't brokers that are also marketing these properties, and I'll get to that in a minute. There's extremely high seasonality. These are destination locations, often drive time, and that's going to play into sort of your ability to take price at different points in time. And then there's a really large spectrum of quality of property. So we have some properties that are 10,000, 20,000 a month, and we have some properties that are 400,000 for the month. And so in that regard, you really need to treat each property as its own snowflake, sort of understanding the uniqueness of that property. And then in terms of how you play with the different stakeholders, because we don't require exclusivity, we do need owner sign off on pricing, and it's something that I'll talk through. But we want to understand and segment them sort of on two planes. One, their desire to rent, and two, their desired level of involvement. So we have some owners who want to be really involved in setting pricing and some who are completely deferential to us. That's going to influence what their strategy is. In terms of renters, really broad spectrum there, whether it's single families looking to get away, whether it's corporations looking to have a corporate retreat. And so those are going to play into pricing dynamics as well. And then again, I mentioned that we work with external brokers, and because of this open listing environment, it may put some limitations on the availability of the properties that we have, or our ability to price, where there are different parties that are working with owners to understand pricing. And so that might, influence what we ultimately list at. And, just to sort of speak to that for a second, our owners are generally accustomed to working with brokers to set single period or seasonal rates. And so the way that we approach pricing is a bit of a shift in that sort of paradigm for them. Looking at sort of fitting everything together, I know there's a lot going on here. So just break down each piece individually. Starting with the chart on the left, what we're looking at is example or illustrative weekly pricing trends. The blue line is our pricing or optimal pricing, and that's going to be data-driven based on what we're seeing in the market. The black line is an example of what an owner might request as their pricing. Again, a lot of our owners have pretty strong opinions about where they should be priced, some of which defer to us, some don't. And then the last is that gray line, the average renter budget. And so what we're seeing here basically is sort of two different instances. If you look on the left, this green line here, or highlighted area, what you see is an example of where an owner actually has an opportunity to increase price. So the blue line, which is our data-driven or optimal price, is a bit higher than what they were expecting to get at around the 11,000 a week mark. What you're seeing from a renter perspective actually is that they're potentially interested or willing to pay a little bit more, closer to that 13,000 mark. And so this would be an example of where we might say to an owner, hey, we think you want to be at 11,000, but there's actually room to take price. Let's test at a higher level and see if we can not leave some money on the table. And what we're seeing here in this August timeframe is the opposite effect. So because our properties are really homes first and vacation rentals second for the most part, owners have an intrinsic value in what they place on the home. And there is a bit of an opportunity cost to them not using the home themselves. And so in this example, this owner might want 18,000 for the week. And even though our data-driven approach at around 14, 15,000 is pretty well aligned with what renters are willing to pay, meaning that they know what the value of this period is, it's simply just not worth it for an owner. And so eventually we'll work with them to try to get down to make sure that we're optimizing revenue, but at the same time want to be flexible to reflect their preferences. And then the last piece here on the left is just really adjusting and accounting for that seasonality impact. And so what you see is in the summer months, and this is a Hamptons market example, obviously peak pricing, in the winter and shoulder months, a little bit lower. And to Anurag's earlier point, you want to be scaling that down. It's not just a straight level shift or falling off a cliff. It's more of a gradual decline where you're taking as much price as you can as those individual demand periods start to decrease. And then the only other thing there is that you want to take into account the market factors influence. So in a market with extremely high demand or a favorable sub-market period, all of those curves are going to necessarily shift up. And then the opposite is true, right? In lower demand periods or a less favorable market area, you're going to be shifting those curves down a little bit. And that's how you sort of understand how different properties within the same market play against each other and with each other. And so we talked a little bit about sort of our experience. The next piece that I want to hit on is what are the different strategies and how do you choose the right one for you as a manager? And so just at a high level, we can really group those into what we think are three distinct buckets. So the nightly seasonal approach, and this is a single pricing scheme for a defined period. And this might be useful for properties or markets with a little bit more simplified strategies where we don't need to be, as flexible as potentially a duration-based strategy where you might have a varying pricing scheme over different periods of time or length of stay within the same month. So an example here is you might charge 5,000 for 1 week in one home, and that same home might go for 9,000 for 2 weeks, as opposed to 10,000, the 5,000 times 2. And then the last one here is this hybrid approach, where you're essentially looking to understand demand and employ a combination of nightly and duration-based pricing. And this would be required in a market or for properties that require extremely high flexibility and customization because there are differentiated preferences by owner over time for the same owner or for different properties that are sort of comparables and similar there. And so obviously each of these different strategies have different benefits or limitations depending on what you're looking to do. But if you think about what are the key sort of pricing considerations, right? It's the ability to communicate both with owners and renters. It's the ability to reflect owner preferences. And it's really the ability to employ the strategy on your differential listing systems or your integrations. And so what we say and what we use is this hybrid approach where it may not be as easy to communicate as a nightly rate, which you can go for 1,000 a night for a week or 100,000 for a period, and it might not be as easy to employ even as some of these other strategies. But we've built our sort of internal and proprietary technology, which allows us to seamlessly do both of those things. And so us as Stay Marquis, we're able to turn these sort of red X's here in this hybrid column into check marks, and that's what allows us to succeed and participate in the way that we do in the markets that we're in. So just going a little bit deeper on how do you actually utilize this hybrid approach and what are the benefits in doing so, right? So the first is more properties. this type of approach is extremely marketable to owners because it really highlights the flexibility and customization that they can employ for the listing of their property. And so we're able to get pretty significant inventory benefits by employing an approach like this. The second is no length of stay requirement. So I highlighted this on the prior slide, but I really do want to harp on this here. By being able to list different periods of time for the same property and same month at the same rate, you get owners to open up more nights. So a perfect example is an owner that says, well, I want to earn $10,000 for this week. And our immediate question back to them is, would you take a 2-night booking if you were able to earn that same $10,000? Of course, the answer is yes, and there are ancillary benefits by having lower wear and tear, which is really fantastic for the owner. But at the end of the day, what it does is it allows us to open more nights for that property because they don't need the full 7-day stretch if only 2 of them are available. And so with that, what we get is a bit of search engine optimization. So if you think about the way people are searching, you might have people looking for a property for a week, for a weekend, or whatever it may be. Because of the lower price sensitivity in our markets at the luxury level, you get people who are willing to pay $10,000 for a weekend, even if that same property is really $10,000 for a week, because they're only interested in staying for those 2 days. What that does is it gets more bookings for that same property, which facilitates a better listing score and listing position. And that preferential position, again, facilitates further bookings. And so it's a bit circular, but it builds on itself and sort of perpetuates demand for a property where if you were not able to achieve this sort of strategy, there might be some limitations there. And then the last thing I wanted to highlight is sort of what this looks like in practice. And so what I've done is taken a property that could have 3 different strategies over time. The first is sort of straight up discounting, right? So if a month is 100,000, half of that for 2 weeks is 50, half of that is 25, and so on and so forth. The second is a strategy where you might have the same exact rate for any period for that same property. So this is an example where the owner doesn't really care how long somebody's staying, but they just need to net a certain amount to make a rental worth it to them. And then the last is more similar to a length of stay or duration-based listing where there's going to be some level of discount. So if a month goes for 100,000, 2 weeks might go for 60, half of that for a week might be 35, because you want to encourage someone behaviorally to take a longer length of stay. So we've talked a little bit about sort of the frameworks and approaches that we're using. The last piece is, again, how does that work from a data perspective? What are you doing with data to fit pricing recommendations into that framework? And so there's really 2 main types. There's external data analysis and internal data analysis. External being you're subscribing to data from outside sources and doing something with it. Internal with your own properties. So from an external perspective, right, we really look at this 2 ways, both the objective and the subjective analysis. Objective being statistical. So this is where we're leveraging a really high number of data points and looking to understand what are the key drivers of pricing. So is it specific property attributes? Is it a number of bedrooms and square footage and size? Is it location? Is it key amenities that the property has that makes it quote unquote better or worse than other comparable properties? And some examples of these types of tests are, linear regression and multivariate regression, ANCOVA, which is something that allows you to isolate different factors to really hone in on the relative importance of each of these drivers of pricing, or something called K nearest neighbors, KNN, which basically groups different types of property profiles and says, well, property over here that's got 5 bedrooms and a pool goes for $1,000 a night, and a property over here that's 3 bedrooms with no pool might go for $500 a night. And so that allows us to sort of use comparable sets and profiles of these different properties or characteristics of those properties to objectively come to a bottoms-up pricing mechanism. But what's extremely important is to actually put this into a real-world business perspective. And so that's where the subjective lens and comparables analysis comes into play. If we can use statistical analysis to say this property should go for $5,000 a night, but we look at the historical booking pattern for that property and it's really only $3,000 a night, then the statistical analysis on its own is no good, because we're going to be overpricing and then therefore decreasing the demand for that property and ultimately not optimizing the booking value. And so these two analyses really need to speak to each other. So you run the one to be objective about it and the subjective piece to test and make sure that they're informing each other as you're continuing to look to optimize pricing. And then the last piece that I mentioned is the internal analysis. So from an internal perspective, this can occur either sort of one for the same property over time, and two for different properties within the portfolio that you're managing, so that you're able to sort of hone in on a really precise price point that makes sense from an optimization perspective. So the first example is what I was talking about, single property over time. So Anurag touched on the ability to use lead time as a lever to understand where pricing should really be falling. So if we're talking about, again, let's stick with the Hamptons market, a summer rental for next June in September, you might want to price up to, if you're looking at this June bar, about the 15,000 a week mark. If you're looking at the June bar again, over time, well, we didn't get a booking at 15, 16,000 a week, let's try it at 13, 14. Still didn't get a booking, and as we approach June, and maybe this is late April or early May that you're looking at it, we drop it down to 8,000. Well, a booking was able to be achieved. What that tells us is for that property, for that period of time, the answer that's the maximum pricing that still has high demand from a renter perspective is somewhere between 8 and 12,000. And so that's where you're doing this constant testing to understand sort of what's the right price point for the right time for that property. The same can be done on the opposite end. So first we looked at this June bar where we were starting out too high. The second is, if you look at this November bar over here on the right, there are examples where each of the price points as you go higher actually were able to achieve bookings. And so what that would tell you is that you have the opportunity to continue testing up. You want to do it in a high lead time environment, so it's sort of a safe space to be wrong a little bit, but you want to be wrong on the upside rather than the downside. You can always go lower as you decrease your lead time and sort of a time value of money line of thinking. But at the end of the day, both of these sort of testing high and going lower, or if you see immediate bookings at a low rate and going higher over time, are going to allow you to take price to your maximum ability. And all of that is within the same property. The second piece of this is looking at it across properties within your portfolio. So it's still internal data because it's within your portfolio, but it's saying I have property A over here and property B over here. I know they're both in the same comp set. This is what's been happening for each of them, and use that information to connect within your portfolio with real transactional data so that you're confident in where things are actually being booked and understanding the market demand at both of those levels. And that's pretty much it. I know I ran through sort of all of that at once, but happy to go back to any individual slide or images to talk through questions and use real life examples.
No, that was great. And I really liked the slide right before that. That was where you're talking about the statistical analysis in relationship with the comparable analysis. I think that's really important because I know a lot of this was very complex, and not everybody's market is the same as yours, and not everyone has those high dollar nightly rates. But I think it's really that to me is a really great takeaway that you can do a lot of statistical analysis on its own, and it may not be enough, but that's why you have to include both sides. So that's great. I know that there's at least one question that Heather had gotten from the audience, but
yeah, we Max, real quickly before we move over to Josh, a question came in specifically for you.
Sure.
Would you mind talking a bit more about the broker relationship? How does that fit in with your pricing expense line or challenges with them?
Yeah, absolutely. So it's good that you sort of hit on both in terms of the benefits and the challenges there, right? So from a benefit perspective, we are obviously in a few niche markets. We're able to work with brokers in other markets that maybe it makes sense for us to expand into, or even in the markets that we have a pretty strong position where they might have inventory that we don't have access to. And so what we're able to do is sort of work together and find a way that's mutually beneficial from an economic and financial perspective, while also making it worthwhile from the owner's perspective to sort of push out and maximize the marketability of that property. So we have experience working with brokers in a variety of ways. In terms of the expense line, it really comes into play on what the commission rate is for that property. And for that, I would say it's sort of differential and depends on the very nuances of the relationship, what the property is, what the timing is, and sort of what's the need that we're fulfilling at that time. We do work with a couple brokers on a longer term basis, and so that just depends on having comfortability really with the partnership, because that's really what it is. It's not just one-off here or there. It's making sure that we're on the same page and have mutually aligned goals for the rental of that property.
And that's like with the real estate agent office, like whatever you negotiate, right? You have to know that's your cost of doing business.
That's right. And so I know we had a session earlier about profitability and who pays what fees. And so ultimately what we're sensitive to based on our relationship with owners is preserving the economics for them. And so we want to make sure that if we set them up to net $10,000 for a specific booking, regardless of where it comes from, they should be netting at or at least very close to that amount, because otherwise it's going to deteriorate our relationship with that owner, who's really our ultimate customer in addition to renters, of course. And so we want to make sure that we're set up in a way that everybody's comfortable with the economics and set up to succeed, while not sort of having any drag there on the relationship.
There is one other question.
Okay, go ahead,
Sarah. This one maybe is good for Josh, actually, because it's pretty broad. How would you recommend pricing for Christmas? I'm in Canada. The borders may not be open. How do I know how to price this year? Same, a little lower, much lower? So just a question around like the unknown, right, and the uncertainty.
Right. Well, so in that case, if you're making the assumption that there's going to be more supply than there is demand in that, and certainly more than there would be in a normal year, then at the end of the day, you got to watch the market. So looking at your competitors, looking at the various channels that there's inventory sitting on, VRBO, Airbnb, stuff like that, and watch pricing to make sure that your comps are close to what that your pricing is set close to those individual units comps, and keep an eye on it, because the analogy I always use is that you're landing an airplane, right? You're landing 365 days a year, you're landing that home. You're trying to bring it in on arrival date for as much money as possible. But Christmas may very well become irrelevant in a market where if it's not going to sell out, you're going to be able to get price premiums, I would argue, in most cases. But if you're heavily dependent on folks that are driving across the Canadian border, or if you're running a company somewhere like Hawaii where they've still got travel restrictions, stuff like that, you got to watch what your competitors are doing, because you don't want to be the last. You don't want to be the, what do they say? You don't want to be the last rat off the ship necessarily. You want to be competitive on pricing, because if there's limited demand, you want to get as many butts in beds as possible. And again, you got to almost ignore the fact that you're competing for Christmas. You have an owner, owners are going to have sensitivity, because that's a holiday that they're expecting to bank, to bank in on, right, to cash in on a higher ADR than they might otherwise get for another time period. But at the end of the day, you're competing, and then with that too, from a practical standpoint, you've got to be communicating those things with the owners. So don't forget about that. So make sure that you're watching this stuff, because you owe it to your owners. And if you want to hang on to them from a retention standpoint, you need to be able to speak. You need to be educated on this and understand what's happening in the market for something like that. Because a lot of owners, if you don't communicate to them, they may not give you a pass for missing Christmas. They need to understand why, and it's better if you're out in front of it, just from a practical business standpoint, I guess.
The only other thing I would add there is just to think about the relationship between different periods of time and look at year-over-year performance. So if you know that Christmas is usually 2x, let's say, a week in August, and you look at the week in August this year, because it does reflect the environment that we're living in. And in the past, a week in August was 100. This year it's 50. And so in the past, when August was 100, Christmas would be 200. Well, now August is 50. Christmas can still be 2x at 100, but it's 100 this year instead of 200 like last year, because there's a paradigm shift in the demand.
That's great. And I think that one thing you touched on, I don't even know if you knew you said it, Josh, but you talked about the emotional side of that. And I think that that's where the owners are coming from. They're coming from this emotional side, and we have to make sure that we're approaching it from a really objective position and be able to show them through data, what are we doing for you? Are you earning share? Are you getting share for your home? And that really, at the end of the day, is important.
Right.
Josh, you were able to sit there and listen the whole time. Was there any questions you had for Anurag or for Max?
I think, I guess for both of them, one of the questions I had, I know this comes up a lot, and I'm trying to think of questions that, that the, I guess 107 attendees that are watching right now might ask. And, dynamic pricing is something everybody's been talking about for years or whatnot. And I just, one of the things that I've found is that if there's a small number of units that are actually using dynamic pricing, doesn't really impact the market. So I think there's that question is I guess to clarify that, how often do you guys feel, for both Max and Anurag, how often do you feel like these property managers and the revenue managers should be going through and looking at pricing? How like, assuming everybody's going to do a loop for whatever window they're looking at, 120 days, 180 days, how often should they be circling back for the vacant units?
I can start on that one. Our usual recommendation is at least once a week, like every week, go and check what's happening, because while you don't check, maybe either something is selling out and you don't even realize, and you miss an opportunity there. And then on the other side, for dates that are coming up in the next week, 2 weeks, month to month, every week that you don't check, you might be missing out on some opportunity there where things are not selling, and maybe you need to do something to sell them. Yeah, I mean, was that the question?
Yeah, no, I think that answers it.
Yeah, I would completely agree with Anurag there in terms of lead time being a big factor here, right? So if you're talking about a property that's got availability in 6 months, you might not need to check if it's rented out, every single week leading up to that 6 months. But as you get closer, obviously you're going to want to be checking in more and more often. The other thing is,
right,
peak periods are going to be different than off-peak periods. For a peak period, owners are going to be more acutely aware of whether or not their property is rented out, how much money they've earned or rental income they've been able to accrue over that season. And so that's when you're going to get more involved a little bit.
Right. And the other, I think, Josh, you also mentioned, what if only a very small portion of properties like actually do something about pricing, right? Like regardless of whether they do it using revenue managers or by using some technology, or both, right?
Right.
And the answer, I feel at least, is even if nobody else in your market is changing their prices, if you're in a seasonal market and for whatever reason, and I've seen such markets where the prices are just flat, like for everybody in the market, prices are flat.
Right.
That doesn't mean you should be flat, right? Like you should do what works for you, regardless of what others are doing. If you look at the sort of the occupancy rates in the area, they will show the seasonality, even if others' prices are not showing. And you can see that occupancy rate change in your own portfolio. Like you don't have to rely on what other people's occupancies are for that. And you can say, hey, if I'm booking 100% in high season, that means I can bump up the rate just a teeny bit.
Right.
Like Max was saying, like that's your sign to move up a little bit. And then if February is booking at, say, 50%, and you think that maybe you can bump it up a little bit, if you can bump up the occupancy from 50 to 60%, which is a 20% increase, without reducing your rates by 20%, then that's revenue positive. So maybe try that. Yeah. And it doesn't require your market to be doing anything. Like, this is all in your hands in some ways.
Yeah, I couldn't agree more, because this year is a perfect example in our markets that we're focusing in, where demand was sort of through the roof, right? Drive time destinations for wealthier income individuals. And so what you end up seeing in sort of the more amateur individual listings from a pricing perspective is you've got really flat pricing at peak rates for just about every season. And what we see then is owners coming to us saying, hey, I see a bunch of properties that are listed at peak rates for this period on Airbnb, VRBO, whatever it may be. And without being too blunt about it, the real response is, Well, the reason that you still see those properties is because they're available. And so that's why you're able to use dynamic pricing in a way that really generates demand. You know, pricing and marketability are the two big levers there. And so you want to be priced appropriately at the right times. We've gotten the opposite question from owners as well, where we've had pricing conversations and said, hey, you might need to lower by X%. They lower and they get a booking, I mean, literally within hours. And we'll get a phone call that says, hey, you know, we lowered pricing, we got a booking. Did we lower it too much? And on the opposite side of the coin, the answer is no, you dropped it to the appropriate market rate, which met the demand, and that's why you were able to get a booking. When you were at that higher rate, you were above demand, and so you weren't able to achieve one.
I'm gonna hop in here because I know we're running low on time, but I think we're right at our hour. I actually, I'm always worried that I'm never gonna have questions to ask. I actually have a list of 6 here that we're not gonna be able to get into, which is really exciting for me that I actually, I got so much from you guys, and I really thank you for your time and for sharing that with us. There's so much more to talk about, and I'm so sorry we don't have another hour. But with that, I'm gonna go ahead and say thank you to everyone listening, and to, again, the panelists here, and to Amy, who I hope is okay and hasn't blown away in the hurricane. We wish you the best if you can hear us. And thank you all again for joining us. Have a great day.
Thanks, everyone.
Thank you.
Thanks.